Hey, welcome to my channel Explore with Nandagopal. Like the other videos of mine, I'm sure this will also get a lot of support from you all. Thank you. Basically, I decided to do a series of videos on investments, and today is the first one. And going forward, I will release more videos on the investments, which will be in more depth in terms of the investment options, what we're going to discuss today. Okay, so watch out for those videos. So in today's video, basically, as I said, I'll cover the basics. And those who already subscribed to my channel, big thank you. Really, I appreciate your support and keep supporting always. And share with your families and friends this video if you find it useful. And also leave a comment in the comment box. That way, I get some kind of feedback and interaction with you all. For people who have joined first time, thank you so much. Welcome. And subscribe to my channel and hit the bell icon so that you get notified of the videos which are being launched time to time. Thank you. And with this, let me get into the deck. So I have a small deck which is on investments. So let me go through that. So this is the agenda what I have lined up. Investing, overview of investing, benefits of investing, different types which are there, risks and reward. What are the strategies to be looked at, different types of accounts, different tools and resources. And then also tools specific for analyzing a stock or a mutual fund, and then finally investment mistakes to avoid. So this is what we're going to cover in this particular video. So as I said, we already covered this part. Those who are not subscribed, please subscribe to my channel, hit the bell icon. So what is investing? Basically, an act of allocating money or resources to an asset or venture with an expectation of generating profit or a return. Straightforward, isn't it? Why would I part money, hard-earned money, to somebody or to some venture or to some bank or other places if it is not going to grow, right? So it has to happen. So that's the basis of investing. Yeah, right? So let's go to the next one. Well, different types of investments. Basically, we have first one is the stocks. Stock basically is also called as equities or shares. Basically you can buy it in minimum one in India. And there's no limit, or in case if it's a US market, probably you can buy, you can also buy in fractions, so that's possible. So you basically you're buying a piece of ownership. So that's what it means if you buy a stock. Stocks often give good returns, right? Stocks offer good returns. At the same time, it is volatile because it is based on the market conditions and so on and so forth. So you need to be very careful about that. But at the same time, it gives you historically good returns. Bonds, these are all a little more stable, again issued by government, municipalities, corporations and so on. So this again is like a fixed interest which comes with it. So over a period of time, at the maturity, they give you that principal plus the interest. A little more stable compared to stock, but then the returns are a little on the lower side. Okay. Now again, some bonds are again risky, so you need to be careful in terms of the ratings. For example, anything a bond which is AAA or AA is okay. Anything less than that, you need to be careful about it. Okay. Government bonds obviously are very, very, very stable. So you have gold bonds, you have infrastructure bonds, and similar bonds, RBI bonds, and so on. They are all very, very stable. There are some corporate bonds, etc., which you need to look at the ratings and then invest in them. So AAA, AA is okay, but anything beyond that, you need to think about it. It's not. It's risky actually. Then we have the mutual funds. Basically, it's a type of method where you can actually go and buy stocks from the stock market, but in an indirect way through a mutual fund house, right? So you don't have time, you don't have the knowledge of how to analyze balance sheets, portfolios, and then how to analyze a stock and pick up a stock. So what you do then, you ask the mutual fund house through a mutual fund manager to pick up some stocks based on your preferences. So there are different types of mutual funds. For example, there are index mutual funds. There are some different sectorial theme-based mutual funds. Then there are some mutual funds specific to blue chips, IT, and so on and so forth. So based on what is your choice, then there are the amount what you have invested in the mutual fund is divided into those sectors. For example, if you have a sectorial multi-cap kind of mutual fund or a multi-sector kind of mutual fund, right? Then they divide accordingly based on some percentages. So you can actually see that distribution of the percentage when you go to those mutual fund portfolios. Okay. Similarly, suppose if you're investing in an index mutual fund, then obviously it kind of maps the index, the Sensex, the Nifty, and so on. Okay. So, but again, the returns are varying based on the market conditions. ETFs are basically a special type of funds which are like mutual fund, but they can be traded. They're traded in the stock market, so obviously there's a fluctuation in the price throughout the day, right? And then you also have gold ETFs possible, so which means you can buy gold via ETFs, and it's not a physical form. That way, what happens is you don't have to buy and then keep it in the locker and pay those rents, huge rents, right? So this is a better way of buying it. Then, of course, you have real estate. Obviously, evergreen thing. Real estate is always in demand. Space is always in demand. Land is limited, etc. So obviously, there's an appreciation which happens, and then also buying house, you get tax benefits in your, when you're filing tax and so on. So there are benefits in real estate. The risks are also there, but then the returns are pretty high as well. But you need to understand the risks and rewards based on the investment types, right? So every investment has some risk or reward, but again, how much of risk, how much of reward based on the investment type. Okay, so that's something which you need to look at. For example, if you put cash in hand, there's absolutely no risk because everything is with you, but then it is not growing. But sometimes cash in hand is also beneficial. I'll tell you how. For example, let's say it's better to have some cash in hand because you never know when the stock market goes down. You immediately have cash in hand. You can go and buy some good companies at a very cheap valuation, right? So it's better to always have cash in hand as well. Sometimes it helps, right? But at the same time, just not investing anywhere, just having cash in hand is also not good because it's not growing and the inflation is about 7-8%. Then what happens? It keeps eating that much and that value goes down by that much over a period of time, right? Reward again is proportional. Again, if more the risk, more the reward. But again, in the savings bank, you get 3%, whereas the FD you might get 7%. Whereas if you put in the stock market, probably you get mutual fund, probably you might get 15%, and so on. So there is a reward proportionate increase in the reward based on the risks which you are taking, afford to take. So how is risk related to a type of investment? As I said, cash, savings account, and money market are generally considered lowest risk investment. Fixed income, slightly better in terms of reward, but then they are stable, obviously. But then they're not good as the stock market because, let's say fixed FD gives you 6% interest or 7% nowadays, right? Inflation is at, let's say, 7.5 or 8%, whatever. Then you're not still beating the inflation, right? So it is definitely better than savings bank for sure, right? Now then you have stocks. These are considered higher risk investments, but stock prices can be volatile and fluctuate based on market condition, economic factors, and company-specific events. For example, management changes suddenly. There could be a positive or negative news for the market, right? Company as such. The stock market can, that particular company stock can go down or go up depending upon management change. For that matter, let's say government changes. That is also true. For that matter, there is a geopolitical situation. For example, Ukraine, what happened, market started bleeding literally. A lot of people lost crores of money, right? So it can happen. So in 2014 election, market boomed. So there are factors which play on the market. So you need to be very careful. And if you know all these things and if you're in tune with that, then you can ride that wave, the positive wave, right? So that's what it is. Real estate, obviously, as I said, higher potential returns, offers high potential returns, but also comes higher degree of risk. Really? Yeah, it is. Why? Because you saw that very recently in the COVID time. You saw COVID time, all the landlords were crying. The reason is because so many buildings are empty. Because nobody was staying there or no office was functioning, right? So it can affect very badly as well. Okay, so there are these are other factors to be looked at. Alternative investments, for example, hedge funds. These are some specific funds which are targeted towards high net worth individuals, HNIs they will call it. Because the investment itself runs into crores. You need to invest minimum 1 crore plus. So that's the kind of thing. So it's not for every one of us, but then there are investments where you can actually go and invest, and returns are high, risks also high. Investment strategies. Okay, so determine your investment timeline. Very important, right? Length of time you plan to invest can impact your investment goals. Short-term goals or long-term goals. So short-term, for example, the example I've given there is a down payment of house or vacation. Let's suppose you want to go for a vacation and you want to accumulate some money. So you want to accumulate money over a period of a couple of years using RD account, for example. I'm just taking an example, right? Or similarly, if you want to pay a down payment 10% to a housing loan, so you need to accumulate the money, right? It's not that you don't have the money, so you need to accumulate over a period of time. So it's a short-term, maybe a couple couple of years, 2, 3 years, etc. Similarly, if it's a retirement, child education, or marriage, it's a long term as such. So that means you need to start saving right from the day you started your work. Correct? So that's what it means. So there's a long term plan, there's a short term plan. So you need to decide based on that. Defining risk tolerance. I love this point because risk tolerance is something like, it's not that everyone has the same kind of risk appetite, right? Somebody is risk averse, totally risk averse. He doesn't want to take risk at all. Somebody is there who will take any kind of risk, which is, so you need to balance it out depending upon what stage of life you are in, what is your income, and so many other factors. Okay. So for example, I know some friends who are just don't want to talk about stock at all. Seriously, they don't want to talk about stock because they don't like stock, they don't understand stock, they don't want to go on stock. They want to put money in FD and be happy about it. Okay, so there are people who are only live within the means and then take all kinds of risks also. So there are people like that. So you need to be clear in terms of what you're doing, what's the risk appetite. Accordingly, you need to take your investment options. Okay, consider your investment objectives. To align with your financial goals. So whatever you're investing should be in line with your financial goal. What you want to achieve, right? That's something which you need to always have in front of you, right? Evaluate the current financial situation. That's what I said. Don't live beyond your means, right? Don't borrow money. I know some friends who actually asked me saying that, can I take a personal loan to invest in stock market? Absolutely foolish idea. Please don't do that, right? If you want to invest in stock market, if you want to start investing in stock market, for example, if you have a surplus money, then probably around 10,000 rupees, go and start with your stock market, maybe via mutual fund or maybe stock market directly, but it's a small amount. Start with that and then see how it pans out for you, how it works out for you. Based on that, then slowly increase your allocation. Okay, don't borrow money to go into stock market. Never do that. It's a no, complete no. Reassess your goals regularly. Important, right? Because what you said 20 years back is not the same now. So you keep changing it, right? So you need to look at and then rebalance accordingly. Then look at creating diversified portfolios. That's something which you need to look at. Don't put all your eggs in one basket. It's an old saying, isn't it? But that's true even now. Don't put all your eggs in one basket because that way what happens, something goes down, everything goes down. Simple, right? So split your money, whatever. Let's suppose you want to invest 1 lakh, invest that 1 lakh, divide that into some 3-4 parts. One into FD, one into savings bank, some in cash in hand, some into stocks and so on. Okay, so that's what is important. Short term, long term, whatever. Determine asset allocation, which we talked about. Choose investment within each asset class. So for example, I take stock. Now in stock, I want to put some 1 lakh. So now within that stock itself, I can actually again subdivide into multiple categories. For example, I can put some money in large cap, some in mid cap, and some in small cap. The reason is, by definition, small cap is volatile. Large cap is not volatile, right? So what I do is, depending upon my stage of life, what time and right, can I take more risk or less risk? I will put more money in large cap and less money in the small cap, right? So I might put 50% large cap and put 20% small cap and 30% mid cap, right? But suppose if I am in the 30s and I want to, take more chance, obviously I'll put the reverse, right? Because small cap can also give you huge money when they go up. So it depends on what stage of life you are in and how much of risk appetite you have. Accordingly, you apportion it. Okay. Consider adding alternative investments like real estate, commodities, etc. So I said, don't put everything in savings bank, or don't have all cash in hand, or don't put everything in stock, or don't put everything in real estate. So always diversify. Monitor and rebalance, extremely important. The reason is, if things are changing every minute, every second, and every day, right? So you need to keep looking at it. So it's not that you invest and then after forget it for next 10 years. No way. You need to log in, check it out, check how the portfolio is doing, how the things are, investments are coming up. Are they giving you some returns? If not, is the return sufficient? So all those things you need to look at and then rebalance, sell something if you want to sell it, book loss if you want to book loss, and get out of it, right? So these are some things you need to keep doing it regularly. I know some people who are lazy that they don't even want to log into their accounts. That's the problematic one, right? So you need to monitor and rebalance your portfolio regularly. You fix up your time. For example, you might say probably every day I look at, probably I look at every weekend. Whatever it is, what works for you, please do that. Okay. And there are several types of investments which you can look at. One of them is PPF, very, very popular with everyone because government banks, government backed, obviously it's very, very secure. 15 years lock-in period, never mind. But at the end of 7 years, you have an option to withdraw partially some amount based on some conditions like emergency, or you lose your job, or marriage, or you want to build a house or buy land, whatever. Right? So those kind of conditions you can, and there's a portal where you go and log in and you'll get the money back into account. Very seamless it is. So that's one option. After 15 years, if you want to continue, you can continue blocks of 5. That's one option. NPS, again, it's another retirement focused scheme. Very useful. People invest money and then they get pension at the end of retirement. ELS is another very, very popular one because it gives a tax benefit. And also, we have seen the trend is that most of the ELS, the returns are also very good. So I advise you people to actually get into some ELS schemes because it really pays. Okay, this is lock-in period of 3 years, but never mind. FDs obviously is there. As I said, in the diversified portfolio asset allocation, you need to have an FD as well, but that doesn't mean that all the money is in FD. Okay, so FDs are time saving accounts offered bank that offer fixed interest rate for a specific period of time. Now, for example, people who booked FD last 2-3 years back or 3-4 years back, their interest rate could be around 5%, but today's FDs are giving at 7%, 7.5%. So in case that way, what happens? You go and monitor and rebalance it. Maybe you break the FD, or if the FD is almost the end of it, just break and get onto the other one, higher interest FD, right? So those kind of juggling you need to do. RDs. The difference between FD and RD is FD you put a bulk amount up front, here you put in small amounts, and then the interest rates are more or less same. So it's a very good scheme to have. Recurring deposit. ULIPs, again, it's an insurance policy with some amount is put into equity and debt instruments. Okay, so gold ETFs, my favorite. Again, I don't like to buy jewelry for sure because I don't want to buy jewelry. I don't want to buy jewelry and then keep it in the locker, pay rental for the lockers and so on and so forth. And then again, when you fashion changes, you go and give that jewelry into the shop, and then they give you by reducing all kinds of things like making charge, wastage, and all the nonsense. Instead of that, buy like this gold ETFs. This obviously keeps in line with the gold rate. Obviously gold rates going up, then automatically at the end of it, when you want to sell it, you can get the same price without paying for the locker and balance and so whatnot, right? So this is another electronic form of thing. Or you can go for the gold bonds, which the government gives as well. That's also good, and they give a 2.5% interest on top of that. Real estate, obviously, a popular investment. We already talked about it, so let's not get into that. So choosing the right investment account for your gold depends on various factors such as investment horizon, important, risk appetite, important, again, liquidity needs. Do you need money now, or 3 months, next 1 year, or after 20 years, whatever, right? Tax consideration. These are all the important factors. So the tools and resources, of course, what I listed in there, Zerodha is very, very popular. So using which you can buy Upstock, Angel Broker, ICICI. I have ICICI Direct, for example. I have Zerodha, right, and HDFC Sec. So these are all some of them where you can use they all vary in different terms in terms of fees and then the facilities they offer. Are they full discounted brokerage, or is it a full service? Some of the banks, some of the brokers have a bank, demat, and trading account together, like ICICI Direct, for example, HDFC Sec, and so on. Some don't have, like Zerodha, you need to actually link up your bank account, right? So, and again, the reportings and the features what they have varies depending upon different websites. So you need to go and verify and then see what works for you and then pick up one of them. Okay. So these are all some of the websites which I am talking about. Discount brokerage, Zerodha, Grow, Upstock, ATM Money. Okay. And then you have ICICI Direct, then ET Money, the script box. So there are various ones. In fact, there are 5paisa.com. There are so many actually. So you need to go and check it out. Okay. Then after all this is happening and then still you're not able to pick up stocks, or you don't know how to make a decision, etc., then obviously go for financial advisors where there are some people who will experts who are into this business of reading, analyzing stocks and markets, etc., etc. So they will come for a fee, which is or they will be on a commission based as well. So they will advise you in terms of portfolio, then they will manage your basket, money basket, and all these things they will do. There's a small fee which you need to pay annually, subscription, etc., etc. But at the same time, there are two types I talked about. Be aware of the commission-based advisors, because there are some conflicts of interest which happens as well, because they also get some commissions from the products they recommend as well. So you need to be careful, because you take the so my thumb rule is always that you have information in the market, you have websites, there are so much information which for you to digest. You take that, understand. Then in case you are not decided, then probably you can consult some advisors and get the inputs. But ultimately what you're going to buy is your decision, should be your decision, right? Otherwise you're in for trouble. So that's the way you need to look at it. Okay, so let's go next. So these are different tools which are available, like screeners. We'll do a demo of some of the tools like screener, ticker tape, money control, simply Wall Street, and so on, so that you get an idea in terms of how to analyze different stocks and mutual funds, etc. In the next upcoming videos. So mistakes what we do and we can avoid. It's investing all your money in one asset. We talked about it, right? Don't put all your eggs in one basket. Chasing performance, yeah, very important. For example, you look at mutual funds, etc. They will say, oh, this stock has performed so well, or this particular mutual fund has performed so well last 2 years, right? Doesn't mean that it is going to perform that way in the next couple of years. So you need to look at a lot of fundamentals, underlying factors, how the company, who's the management, and so on and so forth, right? You need to look at all these conditions. Also look at geopolitical, what's coming up, how the government is, stable government, not, all these factors come into picture before all the performance. For example, something which is doing so well can go down, and vice versa is also possible. So don't chase the performance. Timing the market. Nobody knows what is the bottom and what is the top peak, right? So don't and then somebody's buying, don't go and buy it. Somebody's selling, don't go and sell it. Use your knowledge, do some research, and be a disciplined investor. So that and long-term investor, stay invested. That way, what happens is the market always, what goes down comes up. That's a fundamental thing. So what happens, sometimes the stock what you're holding, which is a good company, can go down for various reasons. Just hold on, stay put. Immediately it will come back. There are, after some time it comes back, and then it actually multiplies, right? So you need to be patient. That's the fundamental thing in the stock market, or for that matter, any investment purpose. Not considering fees, very important. A lot of minute details you need to read of fees and expenses, because otherwise you might end up paying huge amount of fees whenever you're buying any of the investments. Okay. Emotional investing, again, very straightforward. It is nothing to talk about here. Don't be, because then if you're emotional, then your decision is going to be very bad, obviously. So you need to be careful. Not having a plan. Without a plan, if you invest, you are going to be wandering aimlessly in the market. Lack of knowledge. Investing without understanding investment product, the risk associated with them can be dangerous. Very clear, right? Obviously, if you don't understand, please read up, talk to people, understand, and then start in a small steps. Don't go on big bang theory. It will not work. Okay. Educate yourself. So that's how to avoid mistakes. Basically, educate yourself, create a plan. Obviously, have a clear plan. Stay disciplined. This is what I talked about. Stay disciplined, so that that impulsive action means the problem. So suddenly there's a Ukraine war. It happened recently. Also, Ukraine war. Suddenly market was falling like crazy. For 3-4 days or 5 days it fall. And I know a lot of people went sold so many things. But that is an opportunity to actually also pick up some good stocks. So so that's why that cash in hand sometimes really works. Okay. Diversify a portfolio, right? That's important. We talked about it. Consider fees and expenses. We talked about it. Review and rebalance regularly. I keep repeating this again. Keep looking at it, log in, and then check your portfolio. See what's happening. Is it relevant right now? What you're holding, some stock which is relevant, is it paying back to you, or is it always in red? If that's the case, then book loss and get out, right? So those kind of things you need to do. Seek professional guidance wherever is required as such. So I hope this video was good. It gave you insight into some of the investment options which are available, some tools, and then some of the do's and don'ts, right? If this video is useful, please share with your friends and family, and I hope this gave you some knowledge and you will be in a better position to decide and pick up some stocks, mutual funds, or whatever other investments we talked about. Look for my next video where it will be a little more detail in terms of actually analyzing the stock on different ratios, etc. So that's what my plan is, using some of the tools what we talked about. And leave a comment in case if you want me to cover some other topics as well, so that I'll definitely make an attempt to cover that. Okay. So remember, investing can be complex. It's important to do your own research and consult with the professionals to determine what is best for your personal financial situation. So as I said, there's a lot of information in the market. Collect all those, read up, and in case still you feel shortage, and go and talk to some advisors. Obviously, engage some advisors. Everything you do, but at the end of it, you are the king. What you buy or what you sell should be your decision. That's all. Then you will be safe, right? Thank you so much. I hope it was useful. And please share with your families and friends. In case if you like this video, give a thumbs up, leave a comment, and then subscribe if you haven't subscribed till now. See you in the next video. Bye-bye.